it's not the stocks, bonds, and cash that really matter. It's you being disciplined enough to put money in there. And many people just don't do that. They just don't do it soon enough. They don't do it enough. They make excuses. And for you, if you're thinking about accumulating wealth, you got to stop making excuses. You got to carve out money and start putting it in there, and then be disciplined with that.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Darryl Lyons.
Hey, this is Darryl Lyons, CEO and co-founder of PAX Financial Group, and you're listening to Retire in Texas. This information is general in nature only, not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. Hey, I just want to say thank you for listening, because a lot of you guys tell me in the community that you listen. It's humbling, the amount of feedback I get and how many people listen. So thank you. It's exceeded my expectations. So it encourages me to continue. I kind of look for clues on what to do a podcast on, and a lot of it's feedback from y'all and just conversations in the community. And one that came up recently was somebody asked me about educating kids on money. And then I spoke at St. Mary's University, and a very basic topic on money. And so I'd like to make this specific podcast about the basics, but do not tune out, because you may misunderstand the basics. And I know you're sophisticated. You may have MBA, we have by the way, we have economists as clients. We have senior tax partners. We have people who are very smart financial people that use us. I say all that because I love their humility, that they say, look, there's some things I just don't know. I don't want you to be the person that lacks humility that says, I already know this stuff, so I don't need to listen. So just please listen, indulge me for the next few minutes, because there may be some misunderstanding about a simple concept that could mislead you into making decisions down the road that could be detrimental. So I want to try to go back to the basics. It's healthy for all of us. So let me start. This is going to be a basic show. And some of you guys are going to be like, that's not really basic, but I want to keep it basics. And I want to also make it in such a way that maybe you could share this with the youth, kids or college folks or whoever that might want to understand stocks, bonds, and investing. So let's jump into it, because I don't have a lot of time. I have plenty of time, but I only want the show to be 15 or 20 minutes. So when it comes to, and I'm actually writing while I say this because it's easier for me to do it this way. There's really four major types of investments. There's stocks, bonds, cash, and then alternative investments, which that will typically be like real estate and oil and gas. You've also heard of private credit, private debt, or private equity, cryptocurrency. They're alternative in the fact, and real estate may be an outlier to the alternative, in the fact that they're the historical returns of them are less predictable, and they oftentimes don't provide a consistent income or some combination thereof. So a little bit more predictability in their investment profile. And when I say profile of an investment, how you determine the risk and how you determine the potential reward. It's a little hard to get your head around those alternative investments. Like I said, real estate falls into that alternative category in this conversation. Stocks, bonds, and cash, kind of the staples, the basics of investing. In general, stocks is ownership of a company. So you own a piece of Microsoft. Not enough to go into a store or go online and say, hey, I own a piece of Microsoft, so I get free technology. It's just, they used to give you a certificate, right? And it was a stock certificate. And they don't do that anymore. It's all electronic. But you have ownership of a company. You own a piece of company, and it's really incredible. If you think about it, years ago, 100, 200 years ago, my family didn't grow up with a lot of money. So if we were a serf or peasant, we would continue to be a serf or peasant, because access to land or being a part of a royal family really wasn't in the card, so to speak. So you just kind of keep doing that. But along comes the United States of America and building out a system, a capital market system where anybody can own a company now. Anybody can own a company. Doesn't mean you're the business owner, but you can buy a company through the stock market and accumulate wealth. And there's so much conviction that this has worked over the last several, I guess it goes back much further than the United States, but it's worked so well that the president has just come up with these Trump accounts trying to get people to save early. If you need more evidence to have conviction that investing in the stock market long-term has historically built wealth, that's another show, another conversation for me to convince you. But stocks have historically worked and provided an incredible tool for people to accumulate money. I also want to encourage you to, and maybe be on the show, I might have done one before, I'm pretty sure I did, on the power of compounding. And so stocks, when you own a company, this is an important thing to understand. The company is motivated, the company being the key executives, key leaders, are motivated to grow. If they don't grow, they get fired. Who fires them? People own the stock, ultimately. I mean, it goes through a process, but the CEOs are tasked to grow the company. So let's say the company grows 10% a given year. So the value, and I'm making up these numbers, the value of the company is worth $10 million, and it grows 10%. Now the value of the company is worth $11 million. CEO is tasked to grow another 10%, but not 10% on the original $10 million, on the $11 million. So it's a compounding effect that happens inside of the stock because the company growth is compounding on itself each year. And the value of that share that you own is directly tied to the value of the company. You picking up what I'm dropping? So the compounding effect happens when the executive leadership is tasked to grow the company year after year, and that growth compounds on itself. That's why it works. And then the CEOs and the executive teams are all incentivized to make that happen. Otherwise, they get fired. So it's a pretty powerful system. You just have to spend some time, I think we all do, have to reflect and take a step back and appreciate how it works. And I appreciate ignorance in a lot of ways because over the years, I've seen some very ignorant people say, I've heard it works. I'm just going to trust it and go about life. Then they wake up 10 years later and they've accumulated wealth through the stocks. It's a fascinating system. There's two major types of stocks. There's growth stocks and there's income stocks. The growth stocks are, like I mentioned, that CEO, oftentimes it may be a technology company that that the executive team they sell, they sell AI. Let's just use AI, artificial intelligence. We'll use chips or whatever, right? It doesn't really matter. And they just year after year compound that growth. Now, let me compare that to income stocks. Income stocks, maybe something more like AT&T, older company, still innovating, but they pay out a dividend. So the profits that they make each year, instead of the growth companies take the profits and they just kind of use it to grow bigger and bigger, bigger. But the companies like AT&T or others, they take that income and they pay it out to you in the form of a dividend. Now, if you're going to retire, those dividends are real nice to live off of. But the dividends, just as a side, dividends as a whole in the stock market have gone down quite a bit. So less people have been more attracted to the dividends. Many times, and I haven't heard this a lot lately, people say, give me $1 million of an investment strategy and I just want to live off the dividends. That used to be the way life worked, but dividends have gone down quite a bit over the last several years. So dividends, albeit are still, I think, an important part of your portfolio, have been less of a priority. But it's important to know about the dividends because some CEOs and executives of different companies are tasked to use company profits to just reinvest to what they call something called CapEx, capital investments. And some of them are just paying out the dividends. Having a mix of both is healthy, really. Some stocks that are growth, some stocks that are income. Another category of stocks that I think are important are large, medium, and small company stocks. And a good healthy mix is important. The large companies would be like the AT&Ts or the Intels. Medium size. HEB is not publicly traded. They're privately held. But if they were, the size of the company, which is size is defined as number of shares outstanding times the value per share. But they're privately held. But HEB, a more regional company, would be mid-size, and a small company would be a lot of biotechnology companies, a lot of companies that are smaller, that just aren't as big. Those are going to have more risk, but usually, not always, usually the risk, when you have more risk, this is generally a rule of thumb in life. If you take on more risk, you're going to expect or hopefully get more return. That's the game. There are outliers to that rule of thumb, but that's generally the game. And so if you're going to own small companies, you got to make sure you know how much you own, because if you own too much, you may be taking on too much risk. Now, the third category of stocks are international versus domestic. And we have something called home country bias, which we generally in America want to own U.S. companies, but the international market has merit too. Maybe not China, maybe not Russia, but generally speaking, you're going to want to own companies overseas. I've spoken about this in previous podcasts, but it does create a different diversification factor in your investment portfolio. Bonds, on the other hand, are not a stock. You know that already, but a bond is a loan. A loan that you make to, let's say, AT&T. Now, here's where it's interesting. If AT&T were to file bankruptcy because everyone switched to T-Mobile, they closed their door and they put a bankrupt sign on the door. I remember Michael Scott in the office said, how do you file bankruptcy? How do you declare bankruptcy? And he walked into a room and said, I declare bankruptcy. Thought that was funny. But anyways, if they file bankruptcy, AT&T file bankruptcy, they put a bankrupt sign on the door, and then there's a line to get money because they're waiting for everyone to, waiting for AT&T to sell all their inventory. So the first group in line, the first suits in line waiting for their money are the IRS, of course. They're going to get, if there's anything to sell, equipment, telephones, sofas, if there's anything to sell and AT&T has any money in the bank, then the IRS is going to get theirs. The second group that's going to get their money are any bank that lent AT&T money against the building. So those are called secured loans. And I'm oversimplifying this, but I think you'll get it. The third group that would get their money are any bondholders, anybody that lent money to AT&T. And usually the money's out. There's no money left after that. The last group in line, and they don't even step in line because usually they don't get anything, and that's the stockholders. But here's what's important. The prioritization still matters today in bankruptcy because whoever's in the front of the line is generally the one that gets the least return on their investment. So if the bondholders are closer to the front of the line in bankruptcy than the stockholders, then the bondholders are taking on less risk, and as a result, they get less in return. So bonds are a loan, and if a company goes bankrupt, you might get your money back, but it just depends on how much money that bankrupt company still has in the bank. Now, a bond is a loan, so we need to talk about the terms. The terms of the bond may be 30 years. So it means you give AT&T, keep using them as an example, $10,000, $100,000. Let's say $100,000. You give them $100,000 in 30 years, they'll give you $100,000 back with 4% coupon. They call it a coupon. 4% interest each year. So $100,000, you get $4,000 each year. It's awesome. 30-year bond, that's a long-term bond. A 10-year bond is going to be more intermediate, and a 3 or 4 or 5-year bond is going to be short-term bond. The longer the term, the higher the what they call interest rate risk. And I might get into that in another podcast. But longer-term bonds typically have more of a risk, and you get a little bit better yield because you're lending the money out for a longer period of time. They are able to categorize bonds in terms of risk. Those with real high risk called high-yield bonds. Companies that are slightly more financial, might have financial problems. Those that are really good quality companies are called investment-grade bonds. So bonds usually have less returns than stocks, as you would imagine, because they have less risk. And if you're young, this is just an opinion. I really don't think you should have much bonds. If you're young, I like stocks. That's just my personal opinion. Your financial advisor may sit down with you and have a different recommendation. But if you're young, stocks work much better than bonds. As you get older and you want to kind of dilute the portfolio from a lot of risk, then adding some bonds in there might make sense for you. The third category, I mentioned there's 4 categories: stocks, bonds, cash, and alternative investments. The third category is an investment, just not a good one, and that's cash. That's just a place for you to park your money if you have an emergency. You can go to bankrate.com and see what cash is paying now. There's a little different, there's nuanced ways to define cash, but today's rate, you're going to get 3% return. It's just not enough to keep up with inflation long term. So cash as a long-term investment is really stupid, which really leads me to the greater point, is that long term, what I define, and I think most experts would define long term, some variation of stocks in your portfolio long term really helps build wealth and keep up with rising costs of inflation. The problem is we don't know which stocks to buy. And so what we did, like, I guess it was in this, I want to say this, oh gosh, I was going to say 70s. 70s when 401k came out, but maybe the 20s. The idea of mutually funding an account with thousands of people across the country became available, and that was called a mutual fund. People mutually fund an account. That way you can own 50, 200, or 500 different companies, and that way if one went bankrupt like Enron, you'd be okay. You wouldn't lose all your money. So mutual funds were a way to accumulate wealth long term, and it really worked well, and it still works well. About, I guess, 20 years ago, 30 years ago now, time flies, computers became more prevalent. So the guy that was a mutual fund manager in New York with a nice suit and drove whatever car he wanted, the Bentley, they started questioning whether or not he was bringing as much value, because computers could start to trade stocks instead of him. And so they came up with something called an exchange-traded fund. They have the same last name, fund, right? Mutual fund and exchange-traded fund. They're related. One is with a computer. And again, I'm oversimplifying it. One is not. Which one's better? Well, there's a lot of research on that. Exchange-traded funds have been beating up the New York manager in a lot of categories. Not all of them, but many of them. So today, most people own exchange-traded funds. Exchange-traded funds are really an incredible way for you to own stocks, but not just one, at a low cost, not get overly wrapped around the axle and investment strategy, and be able to do life. You just do life in a way that you can help your money work for you while you're doing life, raising kids and, going to soccer games, working, all that stuff. But exchange traded funds have been really, really helpful. And so to accumulate wealth along the way, diversifying in different types of stocks using exchange traded funds really are one of the best ways to be able to be a long-term wealth builder over an extended period of time. There's just one thing I want to mention about this. It's not the stocks, bonds, and cash that really matter. It's you being disciplined enough to put money in there. And many people just don't do that. They just don't do it soon enough. They don't do it enough. They make excuses. And for you, if you're thinking about accumulating wealth, you got to stop making excuses. You got to carve out money and start putting it in there, and then be disciplined with that. So if you can do that long term, I've seen a lot of people be very successful. There's one other thing I might mention. That's probably the most important factor, so don't discount that. You might want to put a wall around your exchange-traded funds. And years ago, they called this a traditional IRA. You put money in a fund. At the time, it was a mutual fund. You got the tax deduction, but when you pulled it out in retirement, you had to pay taxes on it. That was called a traditional IRA, very similar to 401k. Put money in, you get a deduction, you pull it out, you have to pay taxes. So a senator from Delaware said, I'd like to play the game differently, and this was like 1994. He said, maybe 1996. He said, I'd like to play the game differently, and I'd like for you to name this game after me, and his last name was Roth. So they called it Roth IRA. So Roth IRA, here's how this works. You don't invest in a Roth IRA, so don't misunderstand. You put money into a Roth IRA. You don't get a tax deduction. You buy your exchange-traded funds that own stocks. And then as it grows, you don't have to pay taxes on it while it grows, which is awesome. But when you pull it out at retirement, you don't pay taxes on it then either. So if you wanted to know one of the best ways to accumulate wealth is to be able to use stocks through an ETF with a wrapper around it called a Roth IRA. There's rules around that, so you want to make sure you know those rules. Financial advisor can walk you through that. But that would be the framework. Every single one of our clients at Pax Financial Group, has a custom framework that's based on their unique situation because everyone's different. So that's why personalization is so important. But this should give you enough clues on how to customize the wealth building plan for you. So that way you can wake up one day and say, I did it. I was able to save wealth, and I did it in such a way that made sense, didn't add too much risk to my life, and I was able to enjoy life and make a difference. I hope that helps. I hope that gives you a framework. If you have more questions on this, please email me. I appreciate your emails, Darryl@paxfg.com. And remember, you think different when you think long-term. Have a great day.